Welcome to the Reduce Capital Gains Tax and Minimise Your Estate webinar. Phil, so if you were keen to, it'd be great if you could intro the session with prayer.
Sure, and welcome for those who are just joining us right now. I'm Phil Watson. I'm the digital person for Christian Super. Why don't you join me in praying? So, Father God, we thank you for Monday nights. Let's just thank you for Gavin and his his heart for you and his heart for seeing us all move forward financially. Father, we just ask for your help for Gav tonight, and we just ask for your blessing on his family as they're at home. We just ask for this session tonight that we would learn about capital gains tax, and we do it. We retain the information, and Lord, we just ask for your help for everything that we do, because we know that without Jesus we'd be nothing. So we just thank you for the great blessings that you give us in Jesus' name. Amen.
Amen. Thanks, Phil. Really appreciate it. In terms of the advice tonight, just take it as general advice only, and seek your own specific advice before making any decisions. If you do want specific advice, and we can facilitate it for you, the way that we do that is we have you complete a questionnaire initially. Then we meet with you for an initial consultation. It's where we try to understand your goals, what your current circumstances are, and then talk through the pros and cons of the range of options available to you. That might be sufficient for you, or you might get some value from us preparing written advice to you, so in the form of a statement of advice. That's the next stage. We can then help you implement it and provide ongoing advice. So you can take the process of as far along as you need to or want to, or get value from. So tonight we're covering off capital gains tax and how to minimise capital gains tax, and also about how to maximise your estate. And specifically we're talking about minimising any tax on superannuation death benefits there. So we're going quite specific. But you can check out those other webinars that we've done, the first two in this series on focusing on retirement planning, at cornerstonewealth.com.au/retire 2017. And there also will be a recording of this webinar available, and the slides as well. So if you miss anything, you can go back and check it out. So why sell assets, and why sell assets near retirement? We frequently experience that people want to sell investment properties and shares, etc. at retirement. A couple of reasons why, and it's not just about capital gains tax or managing capital gains tax. It might be that you're reducing debt or eliminating debt on your mortgage or other investments. It might be because you need further liquidity, that is, the income being generated from your properties isn't sufficient to live on, and so you need to sell an asset to provide for the cash flow required in retirement. One that's quite common that we experience is that clients are sick of dealing with tenants or the shareholder information for direct shares, and they just want to make life simpler and just have a single income coming through. And often you can facilitate that with a pension, and there's very little work that you need to do, and it works well to keep life simple, and you don't have to deal with the complexities of problems with tenants and responding to shareholder proxy notices, etc. The other is retirement, and in particular with business owners, they're often selling a business. We're not going to go into that into details, but there are quite effective concessions. They're called the small business capital gains tax concessions that can enable you to sell a business without paying any tax or minimal tax, depending on your particular circumstances. And then the other reason why we sell assets is that we want to get it into the superannuation environment, because there are benefits of doing that, as in it's concessionally taxed, and it can pass to the next generation without tax as well, depending on the components within the fund. And then the other thing is to manage capital gains, because capital gains tax is the hidden death duties. If you've bought an asset prior to, I think, 20th of September 1985, after the 20th of September 1985, then it's subject to capital gains tax. And even if you don't sell the asset and it passes to the next generation, they'll inherit the capital gain or the cost base, and therefore somebody in the future will have to deal with the capital gain. One of the other reasons, and it's getting back to that simplicity, message is that if in retirement you want to keep things simple, one easy structure to manage your finances is to own your own home and with no debt on it. Have a cash reserve of 6 to 12 months living expenditure. So if you live on $50,000 a year, then have $25,000 to $50,000 in a cash reserve, so that if you need funds, you can just access that money quickly. And then often the remainder of your funds can be held in the pension phase of superannuation. It's tax-free drawings, tax-free earnings, and it can be passed tax-free to kids depending on the components that we'll talk about that further in the presentation. So that's a nice simple structure, and sometimes is the reason for triggering selling of other assets that are owned in your own name, for example. So what is capital gains tax? Most commonly, it occurs on the transfer or sale of assets. So it's when CGT operates when there's a net gain. So you've bought something for $100,000, you sell it for $200,000, and that's created a gain of $100,000 in that scenario. It applies to the tax year that the asset is sold in or disposed of. And with property, it's usually the contract date, not the settlement date, that applies. So just be aware of that as well. And there is some discounting. So in the past, I think it's before 1990, if you purchased an asset, you could index it up with inflation, and if it only grew at the rate of inflation, there'd be no tax payable. Whereas after 1990, there was the discount method, meaning that if you hold an asset for more than 12 months, you can discount it by 50%, discount the gain by 50% before applying it to your income tax or your taxable income. And with the examples that we walk through later on, we'll explain that in a bit more detail. So for an individual or trust, for example, where that's being passed through to individual beneficiaries, then the discount is 50%. Within superannuation, in the accumulation phase, the effective discount is 33%. So it's an effective 10% tax rate on capital gains within the accumulation phase of superannuation. So how can you reduce capital gains tax? And the thing to remember here is that if you've actually triggered a gain, as in you've sold an asset for more than you've paid for it, then you've actually made a profit. So it's not actually bad to pay some tax in the scenario when you've made a profit, but if you can minimise it and reduce it significantly, then it's advantageous for your particular circumstances. But there are some exemptions. Your principal place of residence is not subject to capital gains tax. So if you've purchased a home, lived in it for the duration of your ownership, then and you can only have one principal place of residence, and then you sell it, then it would be sold without paying any capital gains tax. There are, as I mentioned earlier, small business CGT exemptions. If you satisfy those certain criteria, you can sell a small business without capital gains tax. And assets purchased prior to the 20th of September 1985, as I just mentioned, are also exempt from capital gains tax as well, because that's when it was introduced. You can reduce capital gains tax by selling in a low income year. So one frequent strategy that we apply is that clients might retire in July, they've got no employment income or very little employment income, and then they sell the asset in that year. They've not only had no employment income, they've had no income generated from the asset, and therefore it's generally a low income year, and you can manage the gain or pay a lot less capital gains tax than if you were employed throughout the year. I just got Catherine asking the question, how long do you need to live in an investment property for it to be considered as a principal place of residence? Well, if it's an investment property, it's not your principal place of residence. So if you've got one property and you live in it, then that's your principal place of residence. If you've got two properties, one is considered your primary place of residence and one's an investment property, and you can only have one at any one time being your principal place of residence. So If you have two properties, one's your residence, and then you decide to move into your investment property, then your investment property would be your primary place of residence, and it would start to be then exempt from capital gains tax from that point. But there will be a pro rata calculation of the gains if you own the investment property, not as your primary place of residence before then. Hopefully that answers your question, Catherine. Reduce, you can, a way of reducing capital gains tax, because the amount of the gain is added to your taxable income, is to reduce your taxable income. And a way of doing that is salary sacrificing any employment income. And you could also make personal deductible contributions. In this financial year, there's a bit more flexibility with one of the rules that was removed to enable everybody, both employed and self-employed people, to make personal deductible contributions to super. And one last one that will only really come into effect from the 1st of July 2019 is the superannuation catch-up provisions, which means that if you haven't utilised your $25,000 contribution limit, your concessional contribution limit each year, and your superannuation balance is less than $500,000, then you can use some of those contribution limits to reduce any gain. And towards the end of the capital gains tax segment, I'll explain that for you. Just checking another question coming through. Ken asks, my house was principal place of residence for 6 years, then became an investment property. Well, in that case, if you didn't have another primary place of residence, that is, you only owned that home and then you leased it out, you can lease it out for up to 6 years and it still be considered a tax-free asset. After the 6 years, then it will be a pro-rated capital gain. Or if you then move back into it for 12 months, then you could actually reset the 6 years and it would still remain a tax-free asset. So yeah, well worth considering or understanding that 6-year rule. You need to live in it. Generally, we say live in it for 12 months to satisfy that principal place of residence rule, and then you can then considered your primary place of residence. Then you can lease it out for 6 years, and then you could either reset it again by living in it in the property for another 12 months after that as well. Hope that answers your question there, Ken. Thanks for the question, and do keep them coming through via that chat section if you want a question answered. So how does capital gains tax work? It's often easy to walk through a practical example. So we've got here a home or investment property that was purchased for $400,000, and then it grew in value to $500,000, and then at that point in time we sold it. So it was sold for $500,000. We purchased it for $400,000. That means the profit or the gain is $100,000. Because we held it for longer than 12 months, that gain is discounted by 50%. So the gain is now $25,000. And because we owned it jointly, so I think in this case, Joe and Mary owned the property jointly. So it's a $25,000 gain each is added to their respective taxable incomes to pay tax at their marginal tax rates. So if we look at Joe, for example, he's still employed. He's earning $77,000 in employment income. He also had some other assets generating $10,000 in interest. And then we add the capital gain, the $25,000 from the sale of the property, to the taxable income as well. Now, the amount of tax that's payable on that $25,000 is 39% of $25,000, which is this $9,750. So Joe's portion of the capital gains tax paid at his marginal tax rate is that nearly $10,000. Now, in Mary's scenario, she gets allocated half of the discounted gain, but she has interest of $37,000 and the gain of $25,000. So her marginal tax rate, earning over $37,000, is 34.5%, which means that on 34.5% of $25,000 is $8,625. Now, there may be a low income tax offset amount in there as well, but it's pretty close to those figures. Now, the total tax payable in this scenario, so a gain of $100,000 resulted in $18,375 in total tax paid on that gain. Now, we could do a range of things to reduce that tax. So if Joe, for example, waited until he retired to sell the asset, he would pay a significantly less tax than if he sold it when he is employed. So that's one option to him. But the option that we're going to talk about is salary sacrificing in Joe's scenario, salary sacrificing up to his concessional contribution limit of $25,000 to try and reduce the amount of tax that he pays. Just one question from a previous webinar about capital gains tax was by Faith, and she asked, how does depreciating an asset or investments annually throughout throughout income tax relate to capital gains tax? Well, just to clarify that, if you've got an investment property and it's and you've claimed depreciation on it, for example, you might have claimed $10,000 a year depreciation. What that does is it reduces the cost base. So in that case, if you held it for let's say you held it for 10 years and you were claiming $10,000 depreciation, that would reduce the cost base from $400,000 to $300,000, which would mean that the gain would increase from a $100,000 gain to a $200,000 gain. So we've kept it simple by not including those types of matters in here, but you do need to factor in those things, stamp duty, selling costs, etc. John asks, we lived overseas for 20 years. We have our primary place of residence in the country and an investment flat in the city worth twice the house bought 10 years ago. We plan to move to the city flat to be our primary residence. How long do we have to live in it to reduce CGT? I will retire in 3 years and my wife in 6 years. John, thanks for that question, John. So how it works is that if you move if you've not lived in that investment property in the city before, effectively the amount that you paid for it to the amount that it's worth now is taxable. But the way that the rule applies, that if you've owned it for 10 years and then you live in it for another 20 years, how it can work is that you could allocate, if you then sold it after the next 20 years, so if you owned it for 30 years but lived in it for 20 years, well, a third of the gain would be a taxable, would be considered a capital gain. If you held it longer than 12 months, then that third would be discounted by half, and so a sixth of it would be added to your taxable income effectively. So that's generally how that would work. Jenny asks, at some point, can you explain how to reduce capital gains tax on gifts to children from our super? Gifts, does it need to be withdrawn and go directly to the recipient? Yeah, I won't be talking about that later on, so it's probably worthwhile just covering it off now, Jenny. If you're wanting to gift money to your children from superannuation, one of the best ways to do it is to move to pension phase. So there are two phases of super. One's the accumulation phase, one's the pension phase. If you move to the pension phase, then any assets sold in a tax-free environment. Sorry, I should clarify that. To an account-based pension, transition to retirement pensions aren't tax-free now this financial year. They were last financial year. But if you moved it to pension phase, withdrew some funds from the pension phase of superannuation, then there should be no tax payable in that scenario. So you could go down that track. Thanks, Jenny, for the question. Now, we're trying to work out how to deal with this gain. So how can we reduce our $18,375 of tax in this particular scenario? Well, in Joe's situation, if we didn't salary sacrifice, this is the scenario. He's got $87,000 of taxable income. We add to that the capital gain. His total taxable income is $112. He would then pay $31,312 in tax. Now, what we could do is he could salary sacrifice up to the $25,000 threshold. Now, this threshold was $35,000 last year, so there's a lot more scope to reduce gains last financial year. But we're limited to $25,000 with this particular strategy this year. So because the $25,000 contribution limit includes your superannuation guarantee, so the 9.5% on Joe's $77,000 income, we need to reduce that amount from the $25,000 threshold. So we can only put in or salary sacrifice $17,685. But what that means is rather than Joe taking that money as income, he's actually directing it. His employer is directing it straight to his super fund. He pays 15% tax on the way in, but that's a lot better than 39% tax that he would pay if he took it as income. So in this scenario, we're putting in nearly $18,000 in directly into super. It reduces his taxable income by, that figure's actually wrong. It should be a slightly higher figure because we've got, it should be the difference between, it should be 17,000. There should be 112,000 left 17,685. So ignore that 87. But the tax figure is correct. It's $24,415. But there is contributions tax of the 15% going into super, which gives us a total tax bill of $27,000, which means that we're saving $4,244 in tax in this particular scenario. The way we're doing it is by salary sacrificing this amount. But this financial year, both employed people and self-employed people can make deductible contributions, so you don't necessarily need to salary sacrifice. But in the past, if you were employed, you had to salary sacrifice income. The problem with that strategy was that if you sold an asset close to the end of the financial year, so if you sold an asset close to June, you might have sold it for $500,000, and it is based on the contract date, but the settlement might have been in the new financial year. But even if you did get $50,000 deposit into your hand, because of the way that salary sacrifice works, you can only salary sacrifice into the future. If you sold the asset in June, you've only got potentially June or half of June's income to actually get into super. So that used to be a real problem. So we used to say, well, it's better to sell an asset early in the financial year because you can salary sacrifice a lot more of your income up to the thresholds, which would then give you a greater benefit. Now, that's not as crucial this financial year if you've got the cash flow to put large chunks into superannuation, but previously that was a significant issue. Winston asks, where does inflation come into the calculation? Much of the apparent increase in asset value is due to inflation. How does this affect the capital gains tax calculation? Well, if you've purchased the asset after 1990, then you don't have a choice to apply the inflationary calculation. But if you purchase the asset between, I think, 1985 and 1990, then you do have the option, I think, to apply the inflationary calculation. But post 1990, it's just the 50% discounting method. So inflation is not factored in at all, Winston. Yeah. Thanks for the question. So that's how Joe was able to reduce his tax through salary sacrifice. So he saved a bit over $4,000 by salary sacrificing up to the $25,000 limit. In Mary's case, she's not employed, and even employed people this financial year can take this approach as well, where rather than having a taxable income of $62,000 and paying nearly $13,000 in tax, she is able to put $25,000 into super, 15% contributions tax or $3,000 $750 is deducted from that $25,000, but she's able to save the difference between that 15% contributions tax rate and her marginal tax rate, which is 34.5% tax, and she's able to save that in tax by doing so. So the end result is that after factoring in contributions tax and the lower amount of income tax payable, Mary in this scenario is able to save just under $6,000 in tax by doing it. So it's well worthwhile pursuing this kind of strategy. We've talked about a very small gain here, and I know a lot of people with investment properties have got a lot more significant gains, so we'll address that shortly. But if you look at this scenario here, so we've reduced Joe's tax on his capital gain from $9,750 down to $5,500. We've reduced Mary's tax from $8,000 down to $2,681, and then we've reduced so the overall tax has come down to $8,187. So the total tax saving there is that $10,188 by just applying this contributions to super type strategy. Now you do need to factor in that the contributions must be made into a complying superannuation fund like Christian Super, for example, or any other complying fund. You also need to make sure that you're eligible to make the contributions into superannuation as well. So if you're under 65, you should be fine to make those contributions. But if you're over 65, you need to satisfy a work test, and you can only make them up until 75, but you still need to satisfy a work test, which is working 40 hours in 30 days. So the latest possible age at which you can make these types of contributions into super is when you're the 28th day after the month that you turn 75. And make sure that you claim them in the year of income, so you make the deduction in the year that you sell the asset. And you also must, if you make a deductible contribution, you must lodge a valid form. Now there's a intent to claim a deduction form that you can get from the ATO website that you need to sign off and say, of this $25,000 contribution, I'm going to claim $25,000 of it as a deductible contribution. You need to make sure that that form is sent to your super fund, in this case Christian Super, and you've received an acknowledgement back that it has been claimed. So the person, you must be entitled to put the money into super. Now, one thing that has changed that I've alluded to a couple of times is that you no longer need to satisfy the self-employed rule. You used to have to be substantially self-employed to make these deductible super contributions. You don't have to. They've eliminated that rule from the 1st of July this year, which is great for flexibility. Now, Ken, I think that's a different question. Ken asks, I lived in my home 6 years until 2003. It has been an investment property since then, now being sold. So it seems my CGT will be calculated from the value of the property in 2009. How do I establish the value of the property at that point in time? Yeah, you just need to speak to an accountant about it, because if you didn't know what the property value was at that point in time, then the other method I think that they use is to just pro rata it. So if I can't remember when you bought the property, whether you've told me or not, but say for example you bought the property in 1997. You've then owned it for 20 years, and 8 of those years would be considered a taxable period. So 8/20ths of the gain would be a taxable gain. They applied those sorts of rules. But check with your accountant to make sure how that, to confirm how that would be calculated if you don't know the value of the property when you moved out of it. Winston says, purchase was early 1990. There must be a date when changes came into effect. Do you have this information? I do have that information. Just let me check what it is though. So I've given you the wrong year. It is actually the indexation method can be utilised not to 1990, but to 1999. So if you purchase an asset between 20th of September 1985 and prior to 11:45 a.m. on the 21st of September 1999, then the net capital gain calculated using an index cost based method, what's called the indexation method, is available, but the indexation is frozen as at September 1999. So you'll be able to use the indexation method between 1990 and 1999, and then I think you've got to go back to the discounting method there, Winston. But it would be good to confirm your particular details with an accountant just to make sure you have that all right. But it's 1999, not 1990, as I stated before. Thanks for the question. So that's deductible super contributions, and very effective in getting reducing capital gains. Just with the timing of getting those intent to claim a deduction in. So you've purchased the property, it might have been a number of years ago. If it's then you sell it throughout the financial year. You can then potentially make a $500,000 contribution to super. Actually, you couldn't now. This is using old figures. So this financial year, you could make contributions of, say, $300,000. I guess if there's a couple and there's two of you that are able to get money into super, you could potentially put into super, if you're under 65, up to $300,000 each. So you could possibly get $500,000 into super. And then after the 30th of June, you can work out how much of that $500,000, let's say it's $250,000 into one spouse and $250,000 into the other spouse's super, you can then work out after the 30th of June how much of that you want to claim as a deduction. And you can claim up to $25,000, but it does include superannuation guarantee, so it needs to be reduced by superannuation guarantee. But just to look at the sequence, you get the money into super before the 30th of June. You need to submit your intent to claim a deduction form and make sure that the super funds received it, and then you get the confirmation back, and then after that you submit your tax return. If you make withdrawals from your fund, it can prevent you from claiming this deduction. So don't make withdrawals from your fund before completing your intent to claim a deduction form, and don't submit your tax return before you submit your intent to claim a deduction form, because they can render your strategy invalid. So it's really important to just factor in those matters when making personal deductible contributions to super. So as a number of you might be aware, that with your investment properties is that the gain is often a lot larger than the example that I just walked through. So we were able to save a fair bit of tax, maybe $10,000 in tax, which is not to be sneezed at. But what if your gain is a lot larger? Well, there is one strategy that may apply, but it is quite a specific strategy, so it might not apply to that many people. But let me explain it for you, because if the scenario does apply to you, there might be significant advantages in pursuing it. So in this case, rather than a $400,000 property, it's a $320,000 property that grows to $1 million, and then we sell it. So the calculation is $1 million of sale price, $320,000 cost base. So we made a profit in this instance of $680,000. We can then discount that by 50% because we've owned it for more than 12 months. So the gain is now reduced to $340,000. And then because it's owned jointly, we're splitting it again. So splitting $170 to Joe, $170 to Mary, and we're assuming there's no other income. So let's, for example, assume that they've retired and they are drawing pension income, which isn't taxable. So drawing money from the pension phase of superannuation. So this is their only taxable income, this $170,000 gain. So they would have a liability here of $54,000 each. So the total capital gains tax would be around $108,000. Now, the strategy that I'm talking about is just introduced but deferred. The implementation of it was deferred. And what I'm talking about here is a catch-up provisions. And if I just show you the benefit of it, and then I'll explain it to you. So if you apply, it's a similar strategy to making personal deductible contributions, but it's basically just using the previous 5 years of unused contributions to super. So you could reduce the nearly 54 down to $22,500,000 each, which could then potentially save you up to around $63,000 in this particular scenario. So you'll have to wait a number of years to be able to apply this strategy, but if I explain it to you, it might apply to a number of your situations. So how it works is that how the calculation works, that for both Joe and Mary, we're just looking at Mary in this instance, but we're using the exact same calculation for Joe. We've got the discounted gain, which is applied to your taxable income. What we're able to do here is if we didn't use our concessional contribution limit for the previous 5 years, we're able to use that in the 6th year. And so we've got a limit in this scenario of $150,000. And so we're making a $150,000 contribution to super. That leaves us with a taxable income of $20,000, and the tax-free threshold is actually $20,500. So there's no tax payable on that $20,000 of remaining gain, but we do pay contributions tax of $22,500, which is that 15% of the $150,000. So in this scenario, we've saved $31,432. Multiply that by 2, and it's getting up to $63,000 of savings. How this works is that it's a new rule that has just been implemented, but it doesn't commence until the 2018-19 financial year. So this particular slide isn't talking about Joe and Mary's scenario. It's just talking about how the catch-up provisions work. One of the criteria is that you need to have a super balance of less than $500,000 to be able to take advantage of the strategy. So if your balance is over $500,000, then you can't utilize this particular strategy. So what happens here is that from the 1st of July 2018, if you don't use your contribution limit of $25,000, then you can roll it forward and use it in a subsequent financial year. So in this particular scenario, we've got someone earning $105,000, and they're being paid the superannuation guarantee of 9.5%, or $10,000 is being put into their super by their employer. So this $10,000 represents the superannuation guarantee. The limit is $25,000, so there's an unused portion of $15,000 that can be rolled over to the next year. Let's say, for example, some paternity or maternity leave was taken the next financial year and no super was put in because they weren't working. Then there's a full $25,000 of unused amount added to the 15 means that there's now $40,000 limit that could be utilized, and so on and so on. So the next financial year we didn't work again, no contributions were made, and so the 25 is added to the 40 to get to 65. And then let's say, for example, we earned or we sold an asset, or we could then potentially put in $85,000, and this is sort of the strategy that we're looking at. Might have been able to then, sold the asset, put in $85,000, which then means that the 25 plus the 65 shows a $90,000 limit available to you. So there's a $5,000 unused portion, and then the next financial year, we've gone back to employment. $10,000 is put in, and there's and that means that with the $5,000 here, there's $20,000 of unused portion. So you can just see how it rolls over each year, but it does drop off the in the 6th year. It does drop off. So you start to lose the unused portion if you go longer than 6 years, because it only does a 5-year catch-up. It only applies to the previous 5 years. So if you don't utilize that amount, then it will be not able to be utilized. So what that looks like, so the way that it would need to work in Joe and Mary's case is that you would have to have, and to be able to utilize that full $150,000 limit, you'd have to have put no contributions in for the previous 5 financial years. And then in this 6th financial year, you could utilize that. Assuming your balance was under $500,000, your super balance was under $500,000, then you could put in a contribution of about $150,000 in the 2023-24 financial year. So because it doesn't commence accruing until the 18-19 financial year, that's next financial year, then selling an asset, if you haven't used these limits, selling an asset in that 23-24 financial year, or a smaller amount in one of these earlier years, could significantly reduce your capital gains tax payable if you've got a large gain that needs to be dealt with. So that sort of wraps up the explanation of capital gains tax. And let me know if you've got any questions there, because I'm about to move on to the next segment, which is really about trying to ensure that the maximum amount of your wealth goes to the next generation or charities of your choice. I don't see any questions coming through, so I'll just move on to that new topic now. So that was all about capital gains tax and minimizing capital gains tax. The next section is how to maximize the benefit to your children when you die. But it could also mean not just passing it on to your children, but passing it on to other beneficiaries and charities as well. Someone's just raised their hand. Just check who that was. Rather than raising your hand, it is better if you can just write a message through via the chat section. It just makes it a little bit more efficient. So if you do have your hand up, just type in the question instead. I'll just quickly check. So that's Alan. Yeah, so Alan, if you've got a question, just type it into the question section and I'll answer it for you. So what we're talking about here is superannuation. So, and what happens with super is that your employer contributions, so it should be 9.5% of your salary goes into your super. Any salary sacrifice contributions that go into your super, and any personal deductible contributions. So these are all what we call concessional contributions. They are called when they're inside of your super account, they're called taxed elements or taxable components. Now, if you die and those components are in your super fund and the money passes to a financial non-dependent, then that balance is taxed at 17%. This taxable component is taxed at 17%. Now, a financial non-dependent might be an adult child, or any other beneficiary that's not financially dependent on you. So spouses are financially dependent, so they wouldn't pay that tax if it went to a spouse. But if you're a surviving spouse in a couple, your spouse has passed away, or you're a single person, then your superannuation needs to be passed on to somebody who's a non-financial dependent, and that tax is generally payable. Post-tax contributions, or what we call non-concessional contributions, are defined as tax-free elements, and they don't pay this tax if the money's passed to financial non-dependents. So the big question is, well, how do I increase the tax-free elements and decrease the taxed elements of your super account? And so that's what we're going to try to explain in the next couple of slides. And the best way to do it is to look at an example. So if you've got a super balance of $120,000 and the taxed components or taxable components that were concessional contributions were $100,000 of that amount, then and the money was, and you passed away and the money passed to your adult children, then 17% of that $100,000 would be taxable, or $17,000. That means of that $100,000, 83 would go to your beneficiaries. With the tax-free portion, the full amount goes to the beneficiaries. So of the $120,000 that you've got in your super account, 103 of it will get through to your beneficiaries. So what can we do about it? How can we improve this by increasing the amount of tax-free components within your superannuation? Well, the strategy is called a cash-out recontribution strategy. And what that means is that of your superannuation balance, when you cash it out from your super and put it into your bank account, it loses the tax component. So if we drew that $120,000, we put it into our bank account, then it loses all its components. It basically ends up being just cash in our bank. So it's $120,000 now sitting in our bank. There's nothing sitting in our superannuation account. If we then, oops, I've gone the wrong way there. If we then put that money back into our super account, if we can recontribute it back into super, then it goes in, and we put it in the form of a non-concessional contribution. Now, this isn't the type of contribution that we use to reduce capital gains tax early. It's a different type of contribution. There are two types, concessional and non-concessional. Now, it's the non-concessional components that enable you to have tax-free components within your fund. So approaching retirement, we often, if we can, clear some of these tax components by cashing out the money and putting it back in so that we can reduce any tax liable on the event of death. So now we've got these 120,000 fully tax-free components. Then if that money passed to a financial non-dependent, then the full $120,000 would be passed rather than 17% tax being payable. So that's basically how it works, but there are a few things that you need to factor in and a few complexities, and the key thing is that there's new contribution limits that are applying now. So but before we think about contributions, actually the first item here is that you need to make sure that there's no tax payable on the withdrawal. So if you're under 60, then sometimes there's a tax-free limit of 200,000 on taxable components. So you can withdraw over a lifetime if you're under 60, $200,000 and not pay any tax. But for those over 60, withdrawals from superannuation from a taxed fund, like Christian Super, are tax free. So, but you just need to make sure that there is no tax payable on the withdrawal. The other thing you need to make sure, as I just mentioned, is that you need to be able to recontribute the funds back in, and there are contribution limits. So they're now $100,000 a year, or $300,000 in any 1 year if you bring forward 2 years, and you have to be over 65. Under 65 to be able to do that. Once you're over 65, the limit is just the $100,000 limit. There's no bring forward rule. Then, so are you within the are you eligible to contribute? If you're over 65, you need to be able to satisfy the work test, which is 40 hours in 30 days. And then the other thing that we often ask about is, are you expecting an inheritance? Because if you are expecting an inheritance, we often choose not to apply the cash out recontribution strategy because we don't want to utilize the contribution limit if we're expecting inheritance, or we might just use each annual limit rather than doing a bring forward of 2 further financial years. So you just need to factor in a few of those items when considering this particular strategy. It doesn't really have much benefit for you as an individual or your spouse, but it's really thinking about maximising the benefit to either charities that you're directing the funds to, or your other beneficiaries, your children or grandchildren, for example. Just got a couple of questions coming through. So just Alan, is there a maximum age to make a concessional contribution? Yes, there is a maximum age. It's currently 75 years, but between the ages of 65 and 75, you need to satisfy a work test, which is working 40 hours in 30 days to be eligible to make a contribution to super. And you only need to satisfy that once throughout the financial year. So it might be working 10 hours a week for 4 weeks. It might be working 1 week at 40 hours, 1 40-hour week. You only need to do that once throughout the financial year to satisfy that work test and be eligible to make contributions to super. So that's the cash out recontribution strategy. Do let us know if you've got any questions, because now I'm going to walk through the questions that were asked on registration of the webinar. So I'll just, I think there's 2.5 slides of questions that I'll walk through, but I'll prioritise any of your questions that you have. So if you do have questions you want asked, just type them into the chat section and I'll address them for you as a priority over these questions for people that might not be online. So thanks very much for joining us. I do appreciate that. It's 9:24 by my clock here, so if you do need to go, feel free to, and you can check out the recording. If you do want further information, the previous webinars were at cornerstonewealth.com.au/retire 2017. We'll email you a recording of the webinar. It'll come through about 8:30 tomorrow night, all being well with me getting the recording prepared. The next webinar is on Centrelink and the age pension, so explaining everything about the age pension. Well, not everything, but the main points about Centrelink and the age pension. That'll be on the 23rd of October. I'll send a link to that, a registration link to that in the webinar recording email. If you do want personal financial advice, then contact us either via our website or give us a call on that 1300 275 428 number. And then there's also the help desk, the Christian Super help desk, where people can assist you with information there as well. So 1300 360 907 or christiansuper.com.au. So no questions are coming through at the moment, so I'll just run through the ones that I do have online. So Barbara asked, selling my house, which is my only house, but I haven't lived in it for 12 years. That's similar to the questions that we had throughout the session, where if you haven't lived in it for 12 years, I don't know how long you lived in it before then, but if you lived in it for 12 years and then didn't live in it for 12 years, then there's probably a quarter of the gain that would be applying, because there's that 6-year rule, that 6 years where you can be leasing it out for 6 years and capital gains tax still might not apply. So it might be around a quarter of your gain that might be taxable, and if it's and then also discounted by 50% as well. So it's something along those lines that would be applicable, but it's well worthwhile just checking with your accountant the intricacies of your particular detail. Graham asks whether to stay in the current investment option. It's a good question. It's not really relating to tonight's webinar, but there is a rule of thumb that as you get older, you become a little more conservative with your investments, because you don't want to lose a lot should there be negative markets, which there is. Inevitably there will be. That's how markets work. They go through cycles. So I can't really answer that. There is a couple of options for you. You can log on to your member account and go through the Equip Super calculation tool. It asks you maybe 6 or so questions and helps you decide which is the right investment option for you. That's well worthwhile going through. Otherwise, you can give the help desk, the Christian Super help desk, a call, and they can ask you similar questions and might be able to assist you with with the right investment option decision as well. I think they can also provide you with a statement of advice under the intra-fund advice rules. George asks, capital gains tax on the sale of a block of land. So that's just straight on a block of land. There's no primary place of residence exemption. It's just a pure gain. My understanding is, but again, check with an accountant, that the rates that you paid throughout the years of holding that block of land add to the cost base. So if you spent $300,000 on the block and you paid rates of $50,000 and then sold it for $400,000, then your gain's going to be $50,000, and then that will be potentially halved to $25,000 if you've held it longer than 12 months. And then think through the strategies that we've talked through tonight to try and minimise the gain or the tax on the gain. Richard asks, deciding on when to sell real estate assets to minimise CGT in an environment where some properties will realise a capital loss. One strategy, Richard, that we didn't mention is that you can actually offset gains and losses. So if you do have an asset that is running at a loss, as in you paid more for it than what you're going to sell it for, then you can offset your gains and losses, and it's an effective way to minimise the tax. And losses are actually carried forward. So if you sell an asset at a loss and you don't utilise that loss, it carries forward to future financial years, and you can actually, when you do trigger a capital gain, utilise that loss to reduce your gain. So it's well worthwhile considering selling them either at the same time or the asset in loss first, so that then it can be offset against the gain. If you sell an asset that's got a capital gain in 1 year and then a capital asset that's a loss in the following year, you don't get to offset them. You've got to sell either in the same year or the loss in a prior year. Suen Kim asks, with so little in super at age 63, how do I retire? Simple, humble life, e.g. have Aubrey just 6,000 after 25 years working. Not 100% sure of the question there, but basically saying how do I live? Well, there is the age pension that you should be eligible for, which for a single person is around the $22,000 to $23,000. For a couple, it's around the $34,000 with a full age pension. And then hopefully with the additional funds that you have, you might be able to supplement that age pension amount with some other funds that you do accumulate over the next couple of years. James asks, I have owned commercial real estate for over 10 years. Is there a cut-off time as to when capital gains is waived? No, as I mentioned earlier, capital gains tax is the hidden death tax. It doesn't actually go away. It actually gets passed to the next generation. And so often we think through with clients strategies of managing the gain and ensuring that the gain isn't accentuated into the future. One way we do that is to sell assets, paying little or minimal tax, if we can apply some of these strategies that we've talked about. And then if you get it into the pension phase of superannuation, and its tax-free components, then the earnings are tax-free, the drawings are tax-free, and then the amount passed on to the next generation is tax-free as well. So that's kind of one of the things that we often aim at as advisors to achieve that for clients. It's not always possible depending on thresholds and client situations, but we often get close to it depending on what the situation is. Annette asks, minimising capital gains tax on a rental property. I think we've really covered that off in this session. Colin asks, best approach to minimising return or maximise return on investment and minimise risk to capital. The Australian 200 lost 54 value in the GFC. It's never been recovered. To minimise or maximise return on investment and minimise risk to capital. I guess the only way the main way of doing that is diversification. So diversifying across asset classes. And also, you may, it's probably correct that the top 200 shares in Australia did lose 54% and haven't returned fully to the previous values. But if you actually include dividends in there, you probably would see that it has actually gotten past the value, because the Australian share market with the franking credits, it incentivises Australian companies to pay franked dividends, so pay a lot of returning dividends, whereas companies in the US, where there's not the franking credits, don't distribute as much as their profit in dividends, and therefore their capital value goes up more than what it does on the Australian market. So you do need to factor in the dividends as well, not just the market value into that equation. But yeah, diversification is the key to maximising your return on investment whilst minimising the risk to the capital. And that's whilst, for example, cash and bonds and fixed interest don't return too much at the moment, what they do is provide a dampener to volatility. So in negative years, it really does dampen losses. So that's where diversification is really key. Terry asks, how to sell shares and not to pay too much tax? Well, I think we've talked through. I think our examples have really talked through what you do when you sell an investment property, but the same applies for shares as well. So you can apply the same sorts of strategies. Sell in a low income year, offset capital gains with any losses that you might have, make deductible contributions to superannuation, use the catch-up rules if you're selling after the 1st of July 2019. So applying all these strategies can minimise your gains or your tax on your gains. Alan asks how to maximise super. I'd go back to all the retirement planning and transition to retirement webinars that are available at cornerstonewealth.com.au/retire 2017, Alan, and check out those slides about how to maximise your super. Then we've got Keith, who asks, how does capital gains tax work for a property that was a primary place of residence, then became an investment property? What records are needed? Yeah, good question. We've addressed this a couple of times because a number of people have been in this scenario. It is good if you can get a valuation when you move out or move into a property, as in it changes from being your primary place of residence to an investment property or vice versa. Getting an independent valuation helps with that scenario because you can use that as a base. And then, for example, once you're 6 years of, say, for example, it was your primary place of residence, leased it out for 6 years, it's good to have a valuation at the time that you rent it out. And then if you continue on to lease it out beyond the 6 years, it's good to have a valuation at the 6-year mark as well. So you can factor that in. But if you're working through these issues, definitely speak to an accountant about it to ensure that you have all the information that you need. John asks, we are keen to reduce capital gains tax on a small rented flat that we want to sell in order to buy a house for our retirement. I think we've covered off most of those questions, but let us know, or those strategies, but let us know if you've got questions, John. Ruth asks where to invest money from a recent inheritance. Often, as I mentioned earlier on that slide where I had you own your own home, you've got a cash reserve of 6 to 12 months living expenses, and then the rest of the money in the tax-free pension phase of superannuation is great. So if you are eligible to get the money into super and roll the money to pension phase, it is a really effective way to invest your funds. I've just got a question coming through, so I'll quickly jump to that. Tony asks, does it have to be a valuer or real estate agent okay? I don't think from an ATO perspective I don't think there's a specific rule as to how you value it, but having some evidence behind how you came to your valuation is the key. But again, talk to your accountant about it to make sure. Yeah, obviously an independent valuer probably has more substance, but if, for example, a real estate agent provided you a valuation and provided 3 properties with very similar with recently sold, then that's really your best example of how to get a valuation on a property anyway. So I think either's fine. There's no specific rule from an ATO perspective. Jenny says, I have to leave now. Thanks for the webinar. It's a pleasure, Jenny. Thanks for joining us. Have a good night. So now we're on to Sue's questions. Keep them coming through via the chat section if you do have other questions. But just got another one coming through. Tony Holland. Thanks, Gab. Pleasure, Tony. No worries at all. So Sue's understanding retirement funding and the implications of using your home to rent rooms, etc., to supplement income. This is well worthwhile. If you're thinking about doing this and you are eligible for the age pension, I'd sit down with a financial information services officer. So they're a free sort of financial advisors within Centrelink. Often they're good. Sometimes you get a less helpful one, but often they're really good. And you can ask them about this particular question. But the way it works is that how much of the income is accessible depends on the type of service you're offering. So if you're just renting a room, then I think more of the income that you're generating is accessible from a Centrelink perspective. If you're providing boarding and meals and more services, then I think less of the income is accessible from Centrelink's perspective. So you could go to the humanservices.gov.au and search on borders to find out more information, or go to or set up a meeting with a financial information services officer at Centrelink or Department of Human Services. Steve asks, transfer of assets and how to manage deeming provisions. So what I'm alluding to from that question, Steve, is that you're eligible or are receiving the age pension and you want to transfer some assets to, for example, your children, but the problem is that would get caught in deeming and gifting rules. There's ways of doing it. You can stay under the gifting threshold of $30,000 over 5 years or $10,000 a year. But transferring assets from one individual to another does actually trigger a capital gain, even though you haven't sold it to a third party. You've actually transferred it to a different party, which triggers a capital gain. So the same sorts of issues apply. But often there's not a lot of ways to avoid the deeming. So if you've exceeded those gifting rules of $10,000 a year or $30,000 over 5 years, the asset over those limits remains an asset for Centrelink's purposes for 5 years, and then it ceases to be tested as an asset. Keith asks, when to sell an investment property? We missed the webinar on retirement as we're living in the States at the moment. When to sell is dependent on your particular circumstances, what your taxable income is, how close you are to 65. Are you under 65? Are you over 65? What's your contribution limit? Will you satisfy the work test over 65? There's a range of questions that we sort of factor in to work out when the best time to sell an investment property is. But on top of that, you've really got to focus on when can you get the best price as well. So you don't want to wait 3 years to sell an investment property to save $10,000 tax if you missed out on $100,000 of more in sale price. So you need to sort of factor in those things as well. Kerry asks, transitioning to retirement and pension options. Kerry, go back to the www.cornerstonewealth.com.au/retire 2017 and check out the first two webinars, so retirement planning and transition to retirement, and then attend or look at the recording for the next webinar, which is the Centrelink and Age Pension webinar, where we explain all about the age pension. So all those webinars will be useful to you. Estate planning. We haven't done a detailed estate planning session for a while, David, but this is touching on it. One topic that we address in estate planning. But if you really are keen to understand a bit more about estate planning, then shoot me through an email, because I think I've got an old recording of an estate planning webinar from a number of years ago. And then Michael says, dealing with capital gains tax on the sale of a property rented out for some time, family home for some time. I think we've covered off that question numerous times throughout the session, where it's a pro rata capital gain, depending on how long you've leased it for, how long you've owned it for. So we've got another question coming through. So Kenny's saying, if a property owned since 1983 is gifted to a family member, will CGT apply? So being in 1983, it's pre-CGT. So if you transferred it or gifted the asset to a family member, then capital gains tax would generally not apply, because it's not a capital gains tax asset. The family member that you gift the asset to will commence the accruing capital gains as at the date of transfer. So you bought an asset back in 1983 for $100,000. It's now worth $1 million. If you then transfer that asset to another family member today, for example, then there'll be no gain, no taxable tax on the gain up to the $1 million. But then the cost base for the family member that you transferred it to would be $1 million and would accrue as the asset increased in value over time. But there is, in that scenario, sometimes it's advantageous to maintain the asset in the original owner's name, so that you can continue to accrue the gain the value as the value continues to go up. You continue to accrue it tax-free. So they are pretty handy, those pre-1985 purchased assets, because of that fact that you can continue to grow them tax-free. I think we're up to... Oh, yeah, we've done Michael, so up to the next page. Only a few last questions to go. Well done to those of you that are still online and listening to my monotone voice. But yeah, thanks for joining us. Appreciate it. Delphin asks, if a piece of land is registered on my husband's and my name, what impact does this have on us who are seniors but still work? If a piece of land is registered on my husband's and my name, so you own it jointly, what impact does this have on us who are seniors but still working? A piece of land that you own, whether it's in your name or your husband's name or in joint names, it doesn't matter whose name it's in, it's an asset assessed for Centrelink purposes, so for the age pension purposes. If you're still working, then if it's a piece of land, it's real estate, and if it's not generating any income, it'll be asset tested but not income tested. And so if you are still working and your pension is being reduced because of the amount of income you're generating from work, the asset of the piece of land may have no impact on the reduction of your age pension. But if you are asset tested, then the piece of land is potentially causing you to receive less age pension. Yeah, I'm not sure whether I've actually got to the core question there, but hopefully that helps, Delphine. Max asks, as a pensioner, I am over the $375,000, I think the lower asset test threshold. What options do I have, or do I just spend the excess somehow? So what Max is talking about, and it's probably worthwhile checking out the next two webinars, which are about Centrelink. So the next webinar on the 24th of October, I think, is age pension, Centrelink and the age pension, so the basics of the age pension. The webinar after that is some detailed strategies about maximising your age pension. So Max, it'd be worthwhile tuning into both of those. But yeah, there are options like you can spend the money, you can on a trip, or you can spend it on your house because your house is an exempt asset. You can, what else could you do? You can take out some forms of annuities. If you've got a younger spouse, you could hold in your younger spouse's accumulation account if they're not of age pension age yet. So there's a range of strategies that you could apply. But often you're chasing your tail a bit as you're trying to get down under that $375,000 threshold amount. And actually, if they're all made up of financial assets, you'll actually be income tested, potentially be income tested. So yeah, you really need to understand what you're doing there, and to a degree, it doesn't really matter if your pension's reduced a little bit because of your asset levels. Kevin asks how I can reduce fees, tax, and capital gains. It's not really a specific enough question, Karen, so I can't really answer it, but hopefully you've got some value from the session. And final question is, Tessa, when is the best time to sell an investment property? Well, when you can get the highest price and pay the lowest tax, I would say, but it really depends on your own particular scenario. Hopefully the session has been helpful with some ideas on how to manage that. Now, Winston says, time well spent, good night. Pleasure, Winston. Thanks for joining us. I'm just about to wrap up, so if you do have any other questions, Delphine, you're still online, so if I didn't complete your full question, then ask it. Ask a follow-up question via the chat section there, and I'll help you. Eddie says, thanks, Gavin. See you next week. Pleasure, Eddie. Oh, yeah, I think I'm seeing you in Sydney. Yeah, look forward to meeting you in person. Look forward to catching up with you then. Anyone else? Paul, thanks again for joining us. You learn a few things. Oh, that's good. It's great that you learned a few things. Thanks for joining us, Paul. Always good to have you on board. And I think the final slide is just further information there, so if you want some extra info. But thank you all for joining us, and if the age pension and Centrelink is relevant to you, then the next two webinars should provide some great value. God bless and good night.